Good afternoon, everyone, and thank you for joining us. Welcome to the Dialogue Series session. I'm Anjal from the AASB. This dialogue series is held jointly with CPA and CANZ, and the topic for today is fair value. The session will be chaired by AASB Research Director Dr. Eric Lee. Please note that the views shared in this session are not the views of the presenters' organizations, but their personal views. The session will be recorded and made available on the AASB website. Also, you're welcome to ask any questions using the Q&A function in Zoom, and we will try to answer as many questions as time allows. And with that, I'll hand it over to Eric.
Thanks, Anchal, and good afternoon, everyone, and welcome. My name is Eric. I'm the Research Director at the AASB, and I'll be moderating the session today. And today we're going to talk about fair value, and so we are pleased to have Cecilia from Deakin University to share her research with us, and then we will have a panel discussion after the presentation. But before I hand over to Cecilia, perhaps let me quickly set the scene. The topic that Cecilia presenting today is about a component of mergers and acquisitions accounting. Often when a business purchases another business, the accounting for the acquisition can be complicated and complex, and typically involves significant estimates, uncertainties, and judgments. And more importantly, fair value plays an essential role in measuring those acquired assets and liabilities. And today, we're going to zoom in on one specific feature of acquisition accounting, that is earnouts, or also known as contingent consideration. Cecilia will explain what they are and walk us through the research. And then after that, I'll open it up to our panel members to share their perspectives on this topic. The panel members will also talk about fair value accounting more broadly in other contexts, such as valuation or issues in the real estate and public sectors. So with that, Cecilia, I'm going to hand this over to you.
All right, thank you so much, Eric. So good evening, everyone. It's my great pleasure to be here to present my research work on fair value of earnouts or contingent consideration in acquisitions. And I'm happy to discuss the fair value practices in merger and acquisitions and in other research settings. All right, so now I'm going to share my presentation slides. All looking good? Excellent. So this is a study or paper I published on the Accounting Review back to 2024, co-authored with Andrew Ferguson and Peter Nam from UTS. So let's start with some background about earnout. So for example, what is an earnout? So earnouts, also called contingent considerations, those are provisions of M&A agreements that provide sellers of the target with future payments, conditional upon the target business or acquired business achieving certain agreed performance goals. So it could be some accounting hurdles like earnings target or net income or revenue milestones, or could be some non-accounting related like regulatory approvals or clinical trials. So on the screen, you can see like two examples of the structure of earnouts, and they are real examples. So for example, the company, basically the buyer or the acquirer, agreed to pay an upfront payment of $36 million. So that is what we often call upfront payment or closing payment. And then there is an additional payment of up to $30 million is contingent on the acquired business achieving some predetermined earnings target in 2013. So in the other example, again, upfront, a cash payment $500 million, then an earnout up to $100 million for reaching net income milestones. So basically, this is a basic structure of an earnout. So at least two staged payments, one upfront payment and future payments contingent on some performance hurdles. So because of these features, so earnouts in practice are used to bridge valuation gap and to mitigate information asymmetry in merger and acquisitions. So not surprisingly, they are primarily used in acquisitions of non-public targets because of their limited disclosure and significant information asymmetry in the market. And the use of earnout kind of like increased over time. So just in Australia, the use of earnout by public borrowers based on our data increased from roughly 10% in early 2000 to over 25% after 2015. And based on my reading of some articles, I think it peaked around 1/3 during the COVID time. And this trend is also similar in other M&A markets, like in the US as well. So I hope now you have a brief understanding of what is an earnout or contingent consideration in acquisitions. So now I'm going to talk about a little bit more about the fair value accounting for contingent consideration under IFRS 3 or AASB 3 after 2008. So accounting, again, basically the initial recognition and subsequent remeasurement. So please bear with me with 2 minutes accounting tutorial as a university lecturer. I hope this brings you some sweet bitter memories when learning consolidation accounting. So initial recognition. So on the acquisition date, the acquirer or the buyer must recognize earnouts as liability or equity, but in most cases, they are recognized as liability. And then subsequently, at each reporting period, the liability classified earnouts are remeasured with the relevant related fair value changes flow through operating gains or losses. So to have you understanding how does it really work, I have an illustrative example. So let's just use one example on the previous slide. An earnout up to $100 million for reaching net income milestones. So we will start with the initial recognition. So here we're assuming, okay, the acquirer, based on their internal inputs, estimates, they estimate an earnout liability of $80 million on their financial report. And of course, this is level 3 fair value estimate because it is based on certain future of a non-public entity. It includes a sensitive forecast. And again, because in most cases, earnouts used in acquisitions of non-public targets, so there are limited comparables to estimate the value of the earnout liability, like the probability of the target achieving $100 million for net income. And of course, there are unobservable inputs. So this is kind of like the initial recognition. We just assume in this case, the acquirer or the buyer estimates an earnout liability of $80 million at the date of acquisition. So let's move to 1 year after, or let's say in 2013. So 1 year ex post, or 1 year after the acquisition. So the milestones not reached, of course, then the expected earnout payout would be 0. So in this case, the liability classified earnouts are remeasured and lowered down to $0. Again, you will see debit and credit, my favorite as a university lecturer again. So there will be a full reversal of initially recognized earnout liability. So when the acquirer or the buyer reverses the initial recognized $80 million on the credit side, or this reversal will be recorded as a fair value gain of $80 million. So that is pretty much the whole story of my research. So what does this mean? So we just feel like this creates a very counterintuitive effect in accounting, because when the acquired business or when the acquired target didn't achieve or reach the milestones set for this acquisition, it should be interpreted as economic values. However, in their accounting, because of the full reversal of earnout liabilities, they have a fair value gain that is incorporated in consolidated earnings. And if investors or analysts are not able to see through this accounting, then it could be interpreted as accounting good news. So now the next question is, you may feel like, okay, I just want to know how large the size of the fair value gain. So here is again, like one disclosure of the fair value gain on contingent consideration or the fair value gain on earnouts. So for this particular firm, if you just look at their total comprehensive income or basic earnings per share in 2018 and 2019, you feel like, oh, they pretty much performed very well, right? Not much change. But if you look specifically on the nine-item fair value gain on contingent consideration, you will notice that this gain, or let's say this free fair value gain, accounts for almost 30% of their total comprehensive income in 2018 and almost like 16% in 2019. So You can say like the post-acquisition consolidated earnings may be smoothed over time because of the fair value gains from earnouts, or cosmeticized because managers may have other incentives to utilize this accounting trick. All right, so next, what are the main results of my research or the study? So we use a sample of completed acquisitions with contingent consideration or earnouts by Australian public acquirers between 2009 and 2017. We observed that first, the initial earnout liabilities are often overstated. So on average, 68% of the initial earnout liabilities are overstated. So when I say overstate, which means the initial estimates are always higher than the actual payment. So this is very striking. And also, we also check the size of the free gain or the accounting gain. So on average, it's roughly about 56% of the consolidated absolute income, because some firms are actually making a loss. And also, we found that the fair value gain from the earnouts enable 24% of the sample firms switch from a negative to marginally positive net income during the earnout period or during the post-acquisition period. And relatedly, because the initial earnout liability, the estimate, they are included in the purchase price, right? So we know the allocation of purchase price, a large proportion of the purchase price goes to goodwill. So we also found that goodwill is overstated. So here you may think, wow, even if the earnout liabilities are overstated, but when they are reversed, if there is corresponding impairment, the gain and the impairment losses could offset each other, then there should have no impact on consolidated earnings. However, unfortunately, this is not the case. So what we found is initial earnout liabilities are overstated. When they reversed, the acquirers get the gain. Goodwill also overstated, but there is no corresponding impairment when earnout liabilities are reversed. So what else? So again, now you come to this session, you know the economic reasons for this earnout fair value accounting. So if the relevant disclosure are more transparent, then investors or analysts or other users of financial reports might be able to see through the nature of these gains. However, again, what we found is the related disclosure is quite opaque. So for example, only about 1/3 of the sample firms provide adequate level 3 disclosures for earnout liabilities. So include like what kind of valuation method they use, their payout probabilities, what kind of discount rates they use. So most of them, so about like 2/3 of them, do not provide the adequate disclosure on their estimate. And also the underlying reasons for earnout liability reversals are barely disclosed. So as I mentioned earlier, these should be economic values because their acquired entity did not reach the hurdles or the milestones. But in most cases, just saying, look, their earnout liability is no longer payable without mentioning anything about the earnout performance or the performance of acquired unit. And even interesting is the fair value gains are often obscured in other income, or we also have some observations that they use to offset against the selling, general, and administrative expenses. So that are pretty much the two major findings from our research. So some implications we hope our study could make in practice. So for the preparers, I think our findings just suggest that they should treat the earnout fair values as a high-risk level 3 estimate using disciplined scenario design, implicit hurdle probabilities, and disclose post-acquisition earnout performance to improve the transparency of the disclosure. And for auditors, they should challenge the fair value level 3 models to check their payment scenarios, the probabilities, again, the use of discount rates and corresponding goodwill impairment when the earned liabilities are reversed. So for the users of financial reports, like investors, analysts, like they should back out the earnout gains from the core performance and collect reversals to purchase price allocation and goodwill follow through. So again, three takeaways from my research or my presentation today. So first, like we agree that the earnouts are an effective contractual mechanism in merger and acquisitions to help solve the adverse selection problems, to mitigate valuation uncertainty, to bridge the valuation gap in merger and acquisitions. But the current fair value model can distort managerial incentives and also post-acquisition earnings, like the journal entry and the example I showed you previously. And the evidence our study provides points to like the incentive-driven overstatement rather than like unavoidable measurement noise, because we know in practice, the fair value often brings some unavoidable measurement noises because of the uncertain or because of the unobservable inputs. However, in this case, particularly, it is related to merger and acquisitions, the very significant economic decisions managers make. So in this case, we feel like the fair value accounting for earnout moves managers' focus from economic to economic and accounting. So it's pretty much the incentive-driven overstatement rather than some unavoidable measurement noise. But we do believe there are practical fixes. So we would suggest a better presentation of measurement gain or losses. For example, separate line item, so investors might be able to subtract the core performance, and also enhance the disclosure of valuation inputs and earnout liabilities reversals. So at least show something about the underlying reasons why earnout liabilities are reversed, rather than just saying, look, this liability is no longer payable. And of course, the goodwill impairment, though we may have the other session for goodwill, but it is related in this setting. When earnout liability reversed, we should expect the goodwill impairment as well. So that is pretty much my research on the fair value of earnouts. Thank you so much, and I look forward to questions and comments.
Thanks, Cecilia. And that was interesting. And thank you for sharing your research with us. And certainly publishing in the Accounting Review is not a small achievement. So congratulations again. And now let me introduce our panel members. We have start with Ram Subramanian from the CPA Australia, James Moulton from UniSuper, who is also a board member of the International Valuation Standards Council. We also have Rebecca Morgan from Eleanor Investors, and David Hardage, who has both for-profits and also public sector's experience. So thank you all for joining us today. I also want to remind everyone that the views provided in this session are not necessarily represent the views of the respective organizations. So let me perhaps start the discussion with Ram. What Cecilia's research highlight is that there may be unintended consequences when contingent considerations or earnouts are measured at fair value in business acquisitions. Now, on the one hand, recognizing these amounts on the balance sheet is important, right? Because investors need to know, they need to understand that these obligations exist as part of the acquisition of a business. But the challenge is that if the liability is later remeasured and the expected payments does not materialize, those changes can flow through profit or loss. So, Ram, from your perspective, do you see this as a concern in practice? And do you think this is primarily a fair value measurement issue or more broadly an acquisition accounting issue?
Thanks, Eric. And Cecilia, congratulations on a great piece of research. I think it's quite some interesting findings in there that you've pulled together for this event. So well done on that. Just to answer your question, Eric, I think if you think about the two things that you mentioned, fair value measurement issue and acquisition accounting, I think there's a broader picture here to think about, not just those two things which are primarily focused on the accounting aspects coming through IFRS 3 or AASB 3. And also, if we think about earnouts as a fact of life in business transactions, when acquisitions happen of different businesses, it's not just the large end of town that does it. It's across the board. So we see it from small to medium enterprises up to large enterprises, and not all of them, of course, have to do AASB 3 or IFRS 3 based accounting. So it's a common business practice. So you defer some of your consideration to a future date based on certain conditions being met. And so it's not uncommon business practice to see that happen. Now, the other thing, of course, to keep in mind is the agreement that is being pulled together for the acquisition. And sometimes that itself may have some problems or some issues with it in terms of ambiguity around how certain earnout conditions are being met. And I think one has to just Google earnout challenges, and you'll find a number of legal cases pop up on the search findings. So that suggests that there's a lot of disputes that happen where the acquirer and the seller don't agree on the terms and conditions that may or may not result in a contingent consideration payment. Now, Cecilia highlighted quite an important point in her slide pack, which is around the impact of any write down or write back of the liability on potential impairment of goodwill. If you think about the original transaction, the debit goes to assets and liabilities acquired plus goodwill, and the credit goes to consideration paid plus contingent consideration. So arguably, if there has been a reduction in the price as a result of a subsequent remeasurement of the contingent consideration, the entity, the acquirer, does need to consider what does that mean for my acquired assets and liabilities plus goodwill. And is that an indicator of goodwill impairment? Now, this is probably where the previous standard was a bit more robust, where it talks about reliable measurement and a couple of other factors that have to be taken into account. But fair value also should take all those factors into account in coming to the same answer, I would think. But the point I'm trying to make is that the issue is not just about accounting. There's a lot of other things that surround the accounting that have to be taken into account. So what's the contract in place? What are the provisions that are in the contract that relate to the contingent consideration? Have they been well written? Can it be clearly established that there has been a change in the contingent consideration? Because sometimes you can have scenarios where the buyer will agree to a price because they don't necessarily foresee what's going to happen in the future. So they agree to a price that includes a contingent piece, and that piece will be dependent on certain things happening in the future. It might be the buyer is being optimistic about it, perhaps, and thinking that might or might not eventuate. I mean, no harm done from my perspective today, because I can always write it back tomorrow because I don't have to pay it. So there's a few things that come into play here which may impact on why the contingent consideration is subsequently written back. And I think Cecilia's research indicates that quite a lot of it gets written back. And I do wonder how does that impact on goodwill on the other side? And that is quite a good, perhaps it's a further research that needs to be undertaken to see if there's a direct impact between the two. I'll stop there for the minute. Thank you.
Thanks, Raman. That's definitely some good suggestion there for researchers to do more work on this matter. Okay, so now I'm going to turn this discussion to James, who's wearing both valuers and investors hats. But for let's start with your valuers hat for this question. So James, how is contingent consideration typically valued in practice? That is, what are some of the methodologies that are commonly used? And given the uncertainties involved in these arrangements, how confident can valuers like you be in estimating those amounts?
Thanks, Eric. Look, the second part you asked around confidence, I'd have to say at the outset that by its very nature, these are uncertain items that we're dealing with. And so any methodology that we do use will always be from the basis that we're predicting a future event and we're using an estimate in effect to derive a value. On the value front, there's broadly three methodologies in valuation. There's cost, market, and income. For earnout consideration, typically we use the income method. So we look at a discounted cash flow model. And that's because we know that, or at least we expect there to be a future payment. And then we need to discount that payment back to a present value. Now, the challenges come in both what the discount rate should be and the risk associated with that payout. And there's an interdependency or a circularity between the payout itself and the risk attached to it. So how do you account for this uncertainty, which I mentioned before? Now, one method is to look at the payout itself, and that's where we can ascribe a probability. So we can look at a scenario or a set of scenarios, and sometimes that's simplified in a three scenario approach. You'd have a low case, a base case, a high case, but quite often valuers will use statistical modeling to reflect the fact that the scenarios can take many different forms. There's many simulations that could occur, and the most common method, which is an option pricing method, is the Monte Carlo simulation. And this really reflects the fact that there is an asymmetrical payoff. Often we're dealing with a hurdle or a cap attached, and therefore the payout is lumpy on conditions. And so when you run a Monte Carlo simulation, and this is something that valuers are a little hesitant to do, given that in traditional valuation textbooks, valuation math is actually quite simple, but there's a disconnect there in that valuation by its nature is a future gazing exercise. We're trying to predict future events. We're trying to understand future cash flows. And so whilst we have that Monte Carlo simulation, we can input our statistical measures. We can look at the volatility, the mean, we can look at expected growth, and we can try and model out what that EBITDA in 2 years might look like and whether it meets that hurdle. And then once we do, for example, 1,000 simulations, we'll work out how many times that hurdle is met. We'll have the probability, then we can attach that probability to the cash flow, and then we can bring it into a present value term. And so there is still, like I said, the consideration of, well, we've reflected the probability of achievement in the cash flow adjustment, but what's the appropriate risk to attach to that payoff? And the discount rate may be the cost of capital, or it may reflect other factors, or in some cases, it may just be the time value of money, because this is, like was mentioned before, these are contractual payoff mechanisms. And so often the risk attached to them is really just a milestone being achieved and a payment occurring, as opposed to an asymmetrical payoff. So lots of considerations. I think in summary, I would say the best method is the discounted cash flow, which is an income approach. And quite often we pair that with statistical modeling techniques like an option pricing model, but most commonly the Monte Carlo simulation.
Thanks, James. And I think many people would agree by saying that valuation is but a bit of science, a bit of art, a bit of judgment. And I now actually want to get your perspective as an investor, given the uncertainty around earnout valuations. What should investors be mindful of when reading these numbers in the annual reports?
Yeah, I think everything we've discussed already really comes to mind when you read a P&L statement and you're trying to form a view on the earnings of a business, particularly if either you're looking to invest or you're looking to publish an analyst-style report. You really want to adjust for the impact this is having to the P&L, as we're effectively talking about accounting noise, and investors are always interested in cash, right? And that's a commonality that exists between valuers and investors. We want to understand the cash earnings potential of the business, not necessarily how fair value remeasurement can impact earnings. And so the first step is always to isolate these fair value adjustments and then normalize for them. Often we'll remove them from the earnings. We'll do that in our discounted cash flow valuation. We'll do that in our multiples valuation. We're normalizing for these one-off items that are non-recurring and that they don't reflect a cash earnings effect for the business.
Thanks, James. So, Ram, perhaps I could come back to you from a governance and audit perspective. Given the amount of judgment involved in these valuations, what role should auditors play in challenging management's assumptions?
The first thing I'd say is modern day financial statements are full of estimates. So anything that's associated with fair value, especially when you're looking at level 3, which partly is what Cecilia presented to, the estimation is going to be, I mean, I think you used the words part science, part judgment. So looking at it from an auditor's perspective, there's an entire auditing standard on auditing accounting estimates, ISO 540, which tells the auditor how to go about looking at the estimates that have been made in accounting for the contingent consideration. Now, in this context, you would expect the auditors to not only question the accounting treatment itself, but look at the underlying material as well. So what I'm talking about is the contractual arrangements that have been put in place. So the contractual provisions that have given rise to the contingent consideration. So you'd expect the auditors to actually go back and look at that. If necessary, they may need to take expert help. So evaluation experts, perhaps, like James, or it could be a lawyer's help in terms of interpreting the contractual provisions that are giving rise to the contingent consideration. So quite often there will be other experts involved in the chain who will be providing input to the auditors in determining whether the estimate has been correctly arrived at by the preparer. And of course, as with any estimate, the assumptions that underlie it is going to be important, and the auditors will have to obviously challenge those assumptions and be satisfied that the evidence that gives rise to comfort to them is there in arriving at those assumptions that have that underpin the estimates. So I think the auditors do have their work cut out in terms of estimates around contingent considerations, but it's nothing new in terms of how financial statements, modern day financial statements, are pulled together. And I think both the preparers and the auditors, and of course, at the end of the day, investors and users all appreciate that there are estimates in the numbers. And so they need to be able to be comfortable that the estimates have been properly arrived at. And so the auditors will have to look at all these different things in coming to that conclusion.
Thanks, Ram. And now let's move away from earnouts or contingent consideration topic, but we're still on the fair value topic, and let's broaden the discussion slightly. Rebecca, your experience has largely been in the large real estate sector, where fair value measurements is also widely used. Do you see similar challenges in practice when applying fair value, and how are these challenges typically managed?
Yeah, of course. I mean, in real estate, I was once told that there's only one number that really matters in your entire set of accounts, and that's the fair value of your real estate. Everything else around it is effectively noise. And of course, it's a massive subjective number that's sitting there, and it's the one thing that every analyst is looking at when you go and publish your results. I think, you know, we face the same challenge with fair value that anybody who's applying fair value is facing, in that you're trying to estimate forward-looking cash flows. And so there's a level of subjectivity to some degree in those forward-looking cash flows. In real estate, obviously, you've got leases on foot, so that gives you a certain level of certainty around what it is that you've got, that, you know, your cash flows looking forward. But there's vacancies obviously in buildings, and so new lease amounts have to be estimated for those. Plus capex amounts are a really massive thing that can swing a valuation, and those are generally fairly subjective. And on top of that, you've got your discount rates and cap rates that are being selected that are also, can have a huge level of variation in the valuations that you're reporting. So, in the same way that there's a subjectivity in valuing earnouts, there's a subjectivity in valuing real estate assets. We try and get around that with disclosure, but the standards don't really have a lot of prescription in terms of what needs to be disclosed. So often what you'll see in big real estate companies is that when they're reporting on their valuation methods, they give a range. So they'll say, we're applying cap rates of between X and Y, or we're applying discount rates of between X and Y. And that doesn't really give the user a huge amount of information, because you can have a tiny little asset that's got, a really broad cap rate that's a fraction of your balance sheet, and you've got a really large asset that's got, maybe a really tight cap rate that has a huge weight on your balance sheet. And so, how can those valuations move when you've got, if those metrics change? And it's very, very hard for a user to see that when the information is aggregated.
Thanks, Rebecca. And David, we're now going to talk about from the public sector perspective, given that you have experience in the public sector. While public sector entities may not often deal with business acquisitions, are there other fair value challenges that are particularly prominent in the public sector?
Yes, well, we don't have a lot of business combinations or business acquisitions, sorry. I couldn't even find goodwill in the Queensland State Government financials, for example, but we have a lot of fair value that we use. So looking at the Queensland State Government financials, the balance sheet, about $600 billion of assets, 100 odd billion is securities, which are fair valued for a large part. There's about $440 billion of property, plant and equipment, of that, which is essentially all fair valued. About 100 billion of that is land under roads, which we can leave to another topic about what that actually means. So the rest of the 340 billion property, plant and equipment is a combination of land, buildings and infrastructure, which will be valued at various fair value methods. Some using sort of private sector for-profit methods that James mentioned, such as market and particularly income-based approach for some of the electricity transmitters and distributors. And a lot of it's going to be on the replacement cost approach, for example, road improvements and hospitals and other infrastructure assets.
Thanks, David. And that sounds like valuation is such an important matter in accounting, especially for fair valuing. And I'm going to now get James to perhaps answer this question wearing your International Valuation Standards Council board hat. And I understand that the International Valuation Standards Council has recently issued an exposure draft. Could you briefly tell us what the key issues that the exposure draft is trying to address?
Thanks, Eric. And so we issued this exposure draft in January this year, and it's currently out for comment. So if you are interested in providing feedback, that would be most welcome. And you can access that from the IVSC's website. It's available for consultation until April. But what we're trying to do here is, with every iteration of the International Valuation Standards, we take a look back through the comments we receive from the stakeholders, and those might be regulators, auditors, valuers, investors, and reflect that in the standards to make them more consistent, to provide more clarity. And in this iteration in particular, we provided more structured guidance. So rather than saying the valuer should do X, Y, Z, we said the valuer must. And so we made it more practical. We also addressed an emerging area, which is a hot topic across all professions at the moment. That's the use of AI and technology. And we reflected throughout the standards consideration of how valuers are using AI to produce valuations and the steps you need to ensure in order for the valuation to continue to be compliant with international valuation standards. So ensuring you're properly disclosing your use of AI, where you're getting data from, and significant inputs that you've relied on. And I think that touches on two more things that we updated for: valuation risk and valuation quality control. So valuation risk is very topical with what we're talking about right now, and that's the fact that some valuations, just by their very nature, are going to be uncertain. There's going to be a dispersion of outcomes, and there's nothing the valuer can do, even with the best statistical models, to prevent the fact that there's an uncertainty there. And so the standards now talk about how to articulate that in reports, and then also from a valuation quality control perspective, the steps the valuer should undertake throughout the process to ensure that their work has been peer reviewed, that their assumptions are reasonable, they're robust, and of course, lots of disclosure, lots of transparency, and lots of information with respect to what tools the valuers used and what data they've relied on.
Thanks, James. And do you think it will help improve consistency in valuation practice?
I think so. I think where we've got a few things going on at the IVS, and one of those is a partnership we've started with IOSCO, which is the International Organization of Securities Regulators. And the goal there is really to bridge the gap between IFRS, so fair value, and the valuation standards. So I see the international valuation standards as being used by many different stakeholders: tax experts, auditors, regulators, investors, but bridging the gap with how accountants consider their fair value is going to be really important, and providing that consistency and applicability to accounting scenarios is going to be crucial. So we're looking to do that with every iteration, and we've got a current working group happening, which is looking to put an appendix in the international valuation standards, which is talking to the connection with fair value accounting.
Thanks, James. Okay, so Rebecca, in your discussion just now, you mentioned about how in real estate a sector often have reports providing a range of estimates. Are we comfortable with that sort of disclosures?
Yeah, well, in actual fact, I guess what I was trying to highlight is that often those disclosures that end up in financial statements are too high level to be useful. And what you'll see with certain property companies is that they'll publish like a separate document, which isn't necessarily subject to audit, that will actually say what the assumptions were at an asset by asset level, so that, to the extent that, an analyst or whatever wants to go and make their own assumptions about those subjective variables, that they can do so and they can determine their own valuation. I think that's the only sort of meaningful way that information on valuations can be given to, and let's face it, it's going to be a sophisticated reader of those financial reports, because they need to have some sort of valuation knowledge to know how to go and alter those inputs and determine how they'll impact the valuation in their own. But obviously people who watch the real estate space are analysts that are specialists in that area and do know how to do that. So, you'll often find that on investor calls and all that sort of stuff, you'll actually get specific questions about what cap rate did you adopt for this particular asset, what discount rate did you adopt for this particular asset, what income assumptions did you make? Because what they're trying to do is they're trying to tease out, well, if I made that call separately or differently to what you've done, what would that valuation have been? And so therefore, what do I value your business at, as opposed to what do you value your business at? And I think the key thing is that because the standards at the moment don't require that level of disclosure, sorry, I'm losing my voice. Sorry, you're effectively you're back in the realm of unaudited information that people are genuinely relying on to get their information on that business.
Thanks, Rebecca. And James, so in valuations, typically, would you provide a range of estimates, or would you come up with a number from the estimation?
Thanks, Eric. So the new iteration, so the exposure draft that we have out now, actually addresses as a change the fact that valuers can use a range, and that's on the back of previously advocating for a single point estimate. I think personally, when dealing with uncertain matters, a range is very much helpful. However, articulating the bands around that range is very important. As Rebecca mentioned, using one cap rate in the low and one cap rate in the high based on the variability that exists isn't sufficient. There needs to be a story behind why the bands exist, and that needs to be articulated through the narrative and the selection process and the demonstration of professional judgment. So short answer, yes, I think ranges are appropriate because they reflect the inherent uncertainty of a valuation exercise, but they're not useful to the readers of reports unless there's a clear story and articulation of the judgment that's been used in forming them.
And sorry, I might just jump in there, because when you're talking about having that information in valuation reports, that's really helpful. But of course, when you're a reader of financial statements, that information doesn't necessarily feed up into those financial statements. So there's a bit of a mismatch between what you're getting in the valuation reports and what the end users of the financial statements are necessarily getting. And, you know, to the extent that you've got a single asset fund, sure, you can translate it, but that's not the case for most funds. They're multi-asset, and how do you go about aggregating that data meaningfully?
Mm. And that's very topical for this discussion, because what we'd like to see when we're looking at earnouts is what method was used, what are the probabilities, was it performance issue related that it wasn't achieved, just more information and more disclosure. And that impetus exists within the valuation standards and comes out in the reports, as you say, but it's not coming out in financial statements.
Can I just chip in with one comment? It's very interesting that, Rebecca, you mentioned the information being disclosed on ranges separately. Obviously, with financial statements, it's picking a point in that range and placing reliance on that particular point and saying, this is the number that we think is the right number. And when you then provide that range as a separate piece of information, it might give rise to further questions. I don't know if that's the case in your experience, but why did you pick that particular number amongst that whole range, and why do you justify that particular number? And that's quite an interesting question, I guess, that could come up. Now, one thing I do want to say, though, is corporate reporting itself is evolving towards providing range estimates elsewhere. So we do have scenario analysis in climate reporting already, and that's established as part of the reporting framework for climate reporting. So, and that's a range estimate in itself, and that's actually part of the climate report, but we're not talking about that here. We're talking about financial reporting and specifically acquisitions. So yeah, I found that interesting that, you know, when you do provide that additional information, will it give rise to more questions rather than less?
I think it's a good question for James to answer. How do you look at the range of estimates when you make decisions, James?
Yeah, look, it's a great question, and this really goes to something age-old within the practice of valuation, in that valuers want to provide value in their profession. They want to provide something that's more tangible, robust. A single point estimate by its nature sort of conveys that confidence in the estimate, whereas there's hesitancy in the profession to reflect the reality, which is that this is an uncertain outcome and here's a range of possibility. In practice, what valuers typically do is provide the range, and then if a single point is needed, then select the midpoint. And generally speaking, there isn't a whole heap of logic attached to that, only that it exists in the middle. However, often you might see a range, and then rather than the midpoint, the valuer might indicate what conditions would mean the value is closer to the high or the low end of the range. So providing that additional narrative.
Thanks, James. And David, what about the public sector? Do they provide a range of estimates commonly or not common?
No, we get an exemption out of the accounting standards on using the replacement cost basis, at least, because there's so many inputs, and it's not going to help you to work out, you know, the range of, you know, a whole heap of inputs for a road when it's whatever it is, $10 a kilometre, well, not $10 a kilometre, $10 some metric ton for this component, and then this, and then this, and you got all these sort of you know, what they call them, the schedule to work out the the component schedules, where there's a whole heap of items and wage rates and all sorts of things. So we get an exemption from that, but there is still a focus on point estimates to put a number into the balance sheet. I think there's some scope for, looking at, well, there's probably a range, and the values do move. Do you really need to change your value for 3% increase in cost of materials, or maybe it's 10% these days, or more, and force that through the financial statements each and every year? Or is it still within the values range from the prior year and still stay with that previous figure? So there's some practical sides, but yes, the whole bit about inputs is causes some issues, and there is an issue when public sector agencies, particularly local governments, go from one valuer to another valuer, and it gets put into their valuation systems, and a very, 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 very different number comes out from one valuer to the next, and that's often based on estimates of inputs.
Thanks, David. So I'm going to ask a question that has been shared in Q&A, and I know that's been answered. I wonder whether David wants to talk more about it. So the question was about, at the current stage of this webinar, I believe Dr. Hu is referring to contingent consideration / earnouts. They are recognized as a financial liability. Unfortunately, that can sometimes distort P&L, as highlighted. Is there any avenue where preparers can, on initial recognition, recognize the debit side to balance sheet's OCI instead? Thereafter, remeasurement period or liability closeout derecognition, the fair value adjustments are then taken to the P&L along with the initially recognized amount suspended on the balance sheet's OCI. This may avoid distorting the P&L during the period between acquisition timing to when earnout crystallization. David, do you want to elaborate the answers that you have provided?
Yes, well, interestingly enough, the mechanism to make sure that the movements in the contingent consideration didn't go through P&L was the old system. So the old system, you went debit goodwill, credit contingent consideration, and the adjustments for contingent consideration went against goodwill. So Dr. Hu in her paper does talk about this quite a lot because of the change. So there was a mechanism, it got taken away. Not everybody agreed. I'd probably hand over to Dr. Hu, because she has done a pretty good job of contrasting the old system and the new system in her paper.
Yeah, thank you, David. So yeah, that's correct. So before 2008, that was the practice. So contingent consideration will not recognized as liability, or even if it was recognized, and then when the earnout liability is reversed, it goes against the goodwill. So there is no impact on the P&L. But what I'm talking about is kind of like a new one, not that new. It's like accounting change after 2008. So in that case, yeah, David is correct. There is no OCR option for the reversal of earnout liabilities. So that's the reason we document the significant impact on the PL, and also the managers kind of like play around with these numbers.
Thanks, David and Cecilia. The next topic, I want to actually ask Rebecca a question about your thoughts that accounting standards requirements has been giving more weight to market evidence. And what do you think about these requirements?
Yeah, I thought that might be relevant to raise, because we certainly saw, particularly in the office markets, when we had the work from home phenomenon, and it was certainly a sort of a big effect that we saw in real estate, where, the market basically froze up, particularly after, when COVID hit and people started working from home, and people didn't want to trade in office assets because no one was really entirely sure of what the value would be going forward. And there's an accounting requirement that they need to give more weight to market-based evidence in terms of valuations, and I'm assuming that's something that feeds down into the valuation standards. But of course, the market-based evidence for office building trade, sales and acquisitions was really lacking post-COVID, because no one was actually buying or selling those assets. And so what you found was that the cap rate and discount rates that were being derived from market transactions were getting really, really old. And as a result, the values of those assets were still held at sort of pre-COVID levels, when everyone knew that you were really struggling to actually get tenants into those buildings because people were downsizing their space. There wasn't, a lot of office space demand at that time. It's starting to pick back up in the market now, but it just means that the accounting standards have effectively put this sort of unintended consequence into the ability of valuations to react quickly to market changes, because it's telling you to go look for market evidence, but that market evidence is now sometimes 3-4 years out of date, and there just isn't any new market evidence. And yeah, I just think that that's something that's probably worth the standard setters having a look at.
Thanks for sharing that observation, Rebecca. Okay, so I'm going to now ask this question to Ram, Rebecca, and David. There often seems to be a gap in understanding between accounting requirements, as what Rebecca was saying, valuation methodologies, and the limitations of both. From your perspective, how can profession help bridge this gap? And do you think professional training should place more emphasis on things like probabilistic modeling or scenario analysis? Perhaps start with Ram.
Yeah, look, it's an interesting question in that we're focusing here on the accounting profession, I expect, but this topic is not exclusive to the accounting profession. We've got James, who represents the valuation profession and the investor profession, and so there are people here who do play a part in this topic, who come with different skill sets, and I think each profession has to consider how best it can accommodate the necessary learning within its sphere of influence, and also equally make sure that there is alignment with the other professions that are also part of the same topic. So if you're looking at mergers and acquisitions, there's a whole range of different professions that are going to be relevant to that particular topic. We're talking corporate finance, we're talking valuations, lawyers, we're talking accountants, of course. So if we're just talking about the accounting profession and the question of probabilistic modeling and scenario analysis, the answer is yes, of course. I think accountants should have an understanding of how those things work. But equally, as I mentioned earlier with the question we had on auditors, there is also that need to rely on experts where the need arises, and the ability to ensure that you get the right expert help from third-party experts on specific topics that are not within your competence. And I think that's one of the things the accounting profession and we as a professional body have to teach our members is be clear on what your competencies are and make sure that you work within those competencies. Of course, enhance those competencies with new things and different things as you grow your skill set, but also remember to know where your competencies stop and somebody else's competencies are necessary, and use that complementary competencies to make sure that you get the right answer. So in a circular way, the answer is yes, but equally there's more to it than just enhancing the skills of the accounting profession itself.
We don't have a lot of probabilistic and scenario analysis in valuing roads and hospitals. What I'd like to see is because we use the replacement cost approach. So what is it going to cost you to replace it? So I'd like to see the information for fair value be used a lot more or integrated more with operations and the reverse. So the working out your budgets and the future and sustainability asset management plans, which might be 10 years, but for roads, you really need it longer, and use the same information and not just say, please value, go and value it. It should be more integration of how the use of the same information for both future asset management purposes and for fair value, and use the same information, and potentially using something called digital twins to try and reflect what is actually happening with that asset.
Thanks, David. And Rebecca?
I mean, for me, I think it really comes down to disclosure, as I was saying before, because I think the very subjective nature of valuations means that people will have different opinions. And I mean, and that's how people make money, somebody thinks that an asset's worth X and somebody else thinks it's worth more, and that person wants to buy it and that person wants to sell it. I mean, that's the nature of commerce, right? So I think people need to be given enough information that they can make their own judgment about what that thing is valued at. And so, I think that at the moment, the aggregated nature of a lot of reporting makes that very, very difficult for the more sophisticated investor to do. So I think that we need to sort of work out mechanisms to allow that information to flow to investors in a reliable way. Because at the moment, I think financial statements, because they are so aggregated, possibly don't provide that mechanism. I think when we get to the days of more digital type reporting for financial information, possibly there is room then to have richer information that's being given to investors, that I think that maybe the current sort of printed document that you don't want to go past 100 pages is sort of precluding. That would be my my view of the future.
Thanks, Rebecca. And this is a question related to what's the future. So if there's one key message you would like the audience to take away from this session, what is it? So I'm going to start with James for this question.
I think the key message really is professional judgment can't be underestimated when you're dealing with such uncertain events and uncertain outcomes. And whilst you might be equipped with fantastic models, the reliability of the values that you get from them will always depend on the inputs. And whilst you can do statistical type analysis, you can calculate a volatility based on historical results, we live in a very uncertain world where quite often in the case of COVID, in the case of geopolitical events, looking at the past as a predictor of the future isn't going to be helpful. So I'd say professional judgment should always be at the forefront of this type of analysis.
David?
Thanks. Yeah, probably just continue what I mentioned. Seek to work out how you can use your own operational information in the fair value process or the reverse, and just don't use the fair valuation process as a once-off process to plug a number into your balance sheet. Actually use the information in your asset management planning.
Rebecca?
I think it's particularly important for property companies, but I think that people will look at a NAV that's published by, a fund or a property company, and they take that as gospel. That's the value of that particular fund or property. There is no gospel in valuations. We said it at the beginning. There's a lot of subjectivity. It's an art science sort of mixed together. So I think that, if you're going to be serious about going and analysing property-based stocks, or anything with a sort of significant valuation component, then be prepared to know enough about valuations to make your own assumptions and decide what they should be.
Thanks, Rebecca. And Ram?
I was going to say professional judgment, but James already said it, but I will put a different spin on it. I think it's quite important to appreciate that with the onset of the prevalence of the use of technology and AI particularly, the job of doing all the accounting work is being elevated to a higher level. So it's so important and I'm so glad we're having this conversation, because it showcases some of the real complexities and challenges with financial reporting that come to the fore, which maybe one day AI will solve the problem for us and tell us exactly what that number is. But until that happens, we will keep exercising our professional judgment. And of course, the other side of the coin is professional skepticism, which auditors have to exercise all the time in questioning everything that is being placed in front of them. So I think this is where, from a professional body's perspective, we need to be teaching our members that higher level of skills. Exercising professional judgment and also being able to be skeptical and objective about the numbers that are being presented in front of you, whether it is being presented by a technology related output or something else. It's still up to you to question it and provide the right answer or the right interpretation arising from it. Long-winded.
No, that's great. Thanks, Ram. Cecilia, would you like to share anything?
Right, yeah, thank you. So as an academic and someone who is teaching advanced financial reporting at a university, so the message I want to give to everyone is understanding both accounting and underlying economics is always important, no matter which profession you stay with. That is my single message.
Thanks, Cecilia. That's certainly helpful. So, so we are actually at the quite close to quarter past 5. So, thank you, panels members, for such thoughtful insights, and I hope the discussion today has been insightful to you as our audience, internationally or domestically. Certainly, the purpose of this session is not to find any immediate solutions, but to encourage dialogue between researchers, practitioners, valuers, auditors, standard setters. If there's one key takeaway for me from today's session, it is greater awareness. For investors, I hope you understand that there are limitations in business acquisition accounting and fair value, but that doesn't mean that the information is useless, right? So knowing those limitations may help you to look into other sources for making better decisions. And then for preparers, as we have heard from many panelists today, that we hope that after you hear this session, you can think carefully about how information could or should be presented to your stakeholders. So thank you again for joining us today. When the session ends, you will receive a feedback form to tell us what you think about the session today, and perhaps let us know what topics you would like us to discuss in the future. That would be highly appreciated. So thank you again, everyone. Thank you, presenters and panel members, and I'll hope to see you guys again next time. Thank you.
Thank you, everyone.